Dear viewers, welcome to this first episode of Your Life, Your Money in the year 2025. Wish you all a very happy 2025. I have a good news to share with you all. NRI Money Clinic has successfully completed 5 years and we are on to the 6th year. Thank you very much for your love, support, encouragement, comments, and all the good things that you have showered on us. For this year, we have lined up a lot of things for you. As we progress further, I keep telling you what is that we have planned for you. This is NRI Money Clinic for you, and I am Dr. Chandrakant Bhatt, your financial guide for a happy living.
NRI Money Clinic. No hype, just the right advice.
Over 95% of the people do not have proper retired life. The reason is no planning or the faulty planning. What happens during your retirement days is unpredictable. Most of the things that happen during your retirement days can never be predicted in advance. Inflation, interest rate, how long you are going to live, what happens in the case of your spouse, everything is a mystery. Retirement planning is a maze that you have to solve yourself. If you have an intention to create a beautiful retired life, it calls for meticulous planning. I can be of help to you. I have helped thousands of families spread across over 60 different countries in my career spanning over 2 decades. If you want to learn this art of retirement planning, you can attend to my seminar on retirement planning. The details are here. Dear viewers, as a token of our affection for you, we are taking NRI Money Clinic to the next level. This year, we are planning to have a global investor conference. The conference will be held in a hybrid form. That means people who can afford to or who have the ability to reach out to Mangalore can attend the physical event in Mangalore, or those of you who want to attend it from wherever you are, you can attend to it online. The likely dates are February 21st and 22nd. As the days come nearby, we will inform you. We'll put the registration links in our videos. Make sure that you participate in this global investor conference. Great amount of speakers are going to participate in it. They are going to talk about the stock markets, taxation, inheritance, gift city, various things which is of importance to the NRI community will be discussed during this global investor conference. Please look forward to it. We will come to you very soon with the details. The topic that I have brought for you for this week is something which is deadly risky, known as sequence of return risk. If you check on the YouTube, or nobody is going to talk to you much about the sequence of return risk in the stock markets. What is sequence of risk in the stock market? To whom it affects? How deadly it is? How to survive from the sequence of return? I am going to discuss everything in this part of the video. If you are somebody who is investing in the stock market, be it a new guy or somebody who is a veteran of the industry, everyone must be knowing about sequence of returns risk that is built into your investments. Now let's try to make an attempt to understand the sequence of return risk. Now, if you look outside in a greenery, from a distance, the entire green area looks very green, smooth, nice. But you go near that green lawns, you will see small patches inside. So when you watch it from a distance, it all looks green and uniform. Whereas when you observe it very closely, the patches will start appearing in front of you. The stock market behaves the same way. If you look at the stock market and people say stock market has given you 14% rate of return over 30 years, 40 years from 1979, when people talk about the story, you get a feeling that the stock market is giving you 14% return year after year, every year, and you can depend on it. You can count on getting income during your retirement based on this figure. But this is not the true story. This does not tell you the full story. The real story is something different. This entire journey of 14%, which is a truth, it has happened. It's not something that somebody is telling you it's not true. It is true, but it is built with what is known as sequence of return risk. While it is true that the stock markets gave you 14%, but this 14% CAGR did not come as a sequential return. It's not that year on year you got the return, whereas it came in patches. For long periods of time, there was no risk. Many a period of time it gave negative returns. Many a times it gave you suboptimal return. Sometimes the markets went through a spiky up move and it adjusted the lost time. And in the long run, when you see it over 20, 30, 40 years, it appears that it is very attractive. Now, is it something that you have to be worried about? The answer is yes and no both. If you are somebody who is new in the stock market, you are a young person, 25, 30, 35, 40 years of age, and you have an investment horizon of 15, 20, 30 years, you don't have to worry about the sequence of return that is exist in the stock market. Why? The answer is very simple. The sequence of return affects only those people who depend on creating a regular stream of income from the stock market's investment. Am I tending here to tell you not to invest in the stock market? The answer is no. The stock markets, mutual fund, or any constituents of the stock market for that matter are excellent place to invest to create a long-term wealth. I stress the word long-term wealth. But this long-term wealth will not come in a uniform way. It will not come in a very sequential way year after year. You have to know the story that goes along with it. If you're somebody who is young and you are investing in the stock market, you don't need this money immediately. You are putting this money with an idea that you create wealth. Your intention is to harvest this money out in distant future, maybe during your retirement, maybe to buy that house 15, 20 years later, or could be any other life goals. So what happens in between, it doesn't just matter for you. So it just doesn't create any problem for you if you know about it. And you have a salary or you have an income during this period where the stock markets will go through up and down movements. It will not create problem for you. But think about it. Whom does it affect? It affects those retirees who think that I have put all the money in the mutual fund, thanks to all the YouTubers, thanks to the television shows, thanks for all those experts who say you can have a life by creating an income out of an SWP. Make no mistake, it will affect them and it will bite them very, very badly. If you're somebody who is investing into the stock market with an idea that I will leave or create my income during retirement days based on my SWP outflows, then sit right and listen to me carefully about the data that I'm going to dissect for you and analyze, and that gives you an idea what might happen, what are the risks, and how you can conquer that risk. Now let us dig the data a little bit more in detail. I will dig into the data right from 1979 till date. So we have literally a history of 45 years. 45 years history is good amount of data to know what exactly happens in the stock market. First, let us look at between 1979 to 2008. Look at the chart which is shown here on the screen. Now, between this period, the 30 years, 79 to 2008, we had 30 years. In the 30 years, there is so much of an history, so much of a learning which is visible. There were only 20 years where the stock markets gave positive return. Out of 30 years, 20 years there was a positive return. 10 years were negative returns. There are 2 years which I noticed which are returns, positive return, but below 10% rate of return. So if you take a 30 years history, 10 years are negative return, 2 years are sub 10% return, 12 out of 30 years are a period where you could not withdraw the money because markets were not really growing. Look at the stagnation that has happened in the marketplace. When I talk about stock market stagnating, people will not appreciate it. People will say India is not China, India is not Japan. But stagnation can happen in any market. It has happened in the US market between 2000 and 2010. It has happened in India between 1993 till about 2004. Check the chart that I am showing here. Markets were literally stagnant between 1993 till 2004. Imagine a situation if you were to be a retired person and you are counting to get some cash outflows from your SWP. And when the markets go through this kind of a stagnation, what happens? What happens is, instead of you taking out your money out of the profits, what happens is you will start eating up into your own capital. Even though the market recovers subsequently, the amount of capital that will be left in your account will come down and your calculations can go completely wrong. Therefore, please understand, when you are trying to do an SWP, understand that markets give a good amount of money in the long run, but it is not going to be a sequential return, whereas the returns come at unpredictable period of time. There are periods markets give negative return, suboptimal return, sometimes very lumpy return. Between 2003 to 2007, market moved all the way from 4,000 to 21,000 till it crashed down to 8,000. So you get lumpy period of returns. So all in all, what you hear from the market, that markets give you so much time, is a combination of all these things put together. Now, if you are thinking this is a very old history and times have changed, now let us look at the recent history from 2008 to 2024. I get 15 years of data to dissect here. What happened between 2008 to 2024? In these 15 years, there were negative return in 3 years. Only 3 years had a negative return. But there were 4 years which gave suboptimal return, which is less than 10%. Now add these two numbers, 3 years of negative returns and 4 years of suboptimal return. That means out of 15 years, you literally had 50% of the years which did not give you what you are expecting from the stock market. So don't treat the past history as something which cannot be depended upon. Even in recent times also, the story is same. Even going into the future, the market behavior resembles like this. So you can never predict. Now also look at here, between 2008 to 2013, you see how the stagnation happened. In the year 2008, the stock market made a peak of 21,000. Then it came all the way down to 8,000. And look at what happened in the next 5 years. It took markets literally 5 more years to cross that previous hump of 21,000, which means to say between 2008 to 2013, if you had invested at a level of 21,000 on the Sensex for 5 long years, you did not make any money. Rather, the values were much below that. So this is in the recent past. This is not something which is the distant past, what I spoke about. Therefore, if you are a person who is investing in the stock market, keep in mind one thing. Markets give you good returns in the long run, but that's a sum total of lumpy return at short periods of time, combination combined with negative return, suboptimal return, all put together, it gives you a good amount of return. But it cannot be predicted that on a year-on-year basis, you get the same return. When people talk about stock market giving 14% return, people make a visualization of thinking that they have kept money in a bank gives you 7%. Here they get 14% from the stock market year after year. That's not the case. The returns will come at unpredictable periods of time. It is not something which is consistent. The sequence of return risk creates a kind of an illusion in the minds of people. Now you will not know how the returns will come, and that makes you get carried away by all that advertisement and what people talk about. To understand how it creates an illusion, I'll show you some of the charts now. Now first let us look at what did the stock markets do in the last 5 years. You see the graph here which is shown on the screen. You will see the graph looks pretty uniform. It runs like a smooth curve ascending upwards. You get a feeling I invested money and markets are giving me a nice good rate of return. All the good things that happened in the Indian stock markets, the great amount of investors who came into the stock market have come during the smooth phase which is upward looking journey. And now a thought has come in your mind that this is the way the stock market is going to behave all the time. Whether it is true or not, let us see it in another chart. Now let us look at this chart of 10-year stock market return. Earlier I showed you a 5 years return which looked very smooth. Now I am showing you a chart which is 10 years period what happened. Now look at the chart. The last 5 years look like an upward moving line, whereas the first 5 years are looking like a stagnating line or a horizontal looking line. The first 5 years were a period of stagnation. or lackluster performance. The last 5 years, which is from 2019 to 2024, is a period of spike up move. It spiked up because of excessive liquidity which has been infused into the system across globe by governments as a response to the pandemic which was affecting the whole world. So the 10-year graph tells you in contrast that the return does not come at regular intervals of time. It stagnates for a while and there is a return which is coming at some other point of time. Now look at this chart of 15-year stock market return. You'll be surprised to see the returns have come mostly in only the last 5 years. For the first 10 years of this 15 years, market was literally stagnant or behaving as if that it is creating a suboptimal kind of a return. This is the story of the stock market. Now let's look at what happens in a 20-year cycle. Now look at the chart that I have shown you here on the screen. Again, over a period of 20 years, now it appears like most of the gains have come in the last 5 years. And during the earlier phase, it looks like more of an horizontal line. It is not exactly a horizontal line. During that particular periods of time, there were lumpy returns between 2003 and 4 because the Sensex value, which is much higher at this point of time, that looks to be small. But nevertheless, the returns from the Sensex, if we did not have the last 5 years, would have looked lackluster. So you have to be conscious about that how stock market gives return. It is not a daily affair, it's not a monthly affair, it's not a yearly affair. You can't even say that it's every 5 years the stock markets will give you a return. Stock markets will give you return over longer periods of time. That's why in every of my videos I keep telling the ideal investment horizon people have to keep in mind is long term. Long term is more than 10 years. Anything less than 10 years, you cannot predict exactly whether you get a good return, a return which is 12, 13, 14% kind of a return. You can never predict. Look, markets are a function of several factors. Your interest rate, growth, inflation, liquidity, willingness of the persons to come and participate in the stock market and buy the stocks in the mutual funds. That will create a price appreciation. And that's very, very cyclical. That will not show up year after year. Now that you know that sequence of return risk is a major risk, it's a deadly risk, and it's a risk which particularly bites the persons who are depending on SWP during the retirement, you should also know how to conquer this risk. The remedial measures that you can take to overcome this problem of sequence of return risk. First, when you are investing, invest for long term. If you are a retired person, the retired person should also have a mutual fund. But it is not something like that you keep in the mutual fund and you are able to harvest it out year after year. That may not work out or it may work out. Unfortunately, if you are somebody who retires at 60 and markets go through a stagnation immediately after that, whether it's for 3 years, 5 years, 10 years, make no mistake, you will be the person who will be highest affected. Rather, if the stock market gives a lumpy return at 60 years of your age and the bull run runs for 3-4 years, you may come victorious out of this particular bull run. So you cannot predict at what point of time stagnations happen, what point of time the crashes will come in, what points of time markets will go through a massive bull run. That cannot be predicted. So to conquer that, all that is required is you have to have a long-term orientation, which is possible only for people who are in the working age group, salaried person, young person, they can give. If you are a retired person, you should have, apart from the mutual fund and the stock portfolio, you should have fixed income along with it. The second thing that you have to do to conquer the sequence of return risk is you should build a portfolio. Don't buy funds. Buying funds is like, buying an ingredient in the kitchen. You buy vegetables, you buy spices, you buy pulses. These are ingredients. You have to build a balanced portfolio, like a balanced meal. Your portfolio should have everything. Even if you consider a mutual fund portfolio, don't get carried away by the returns that are shown on the Google. Rather, you should have different compartments in your portfolio. It should have a conservative compartment, it should have a hybrid compartment, it should have an aggressive compartment, each trying to do its particular job. Only when you are able to build this portfolio, then let market do anything at any point of time. The required amount of money will be available to you in one or the other bucket depending on what is happening in the stock market. To conquer this risk, build a portfolio, not buy individual funds. The third solution that you can do is always work with financial planners. The role of financial planners, many a time people make fun of. It's your prerogative. You can make any comment. You can write down any comment in this. But financial planners have a role. The financial planners will understand the cyclicity of the market. Financial planners will understand your risk profile. Financial planners will understand your mindset. What can go right? What can go wrong? Financial planners have seen in the lives of so many people what went right, what went wrong, and from the learnings of lives of so many people, they can design portfolio for you. Work with a financial planner. If you get a good one, competent one, ethical one, then they will do a fantastic job for you. Do not hesitate. Use the services of a financial planner. If you have one, you are the lucky one, continue with them. If you don't have one and you need to be assisted by a financial planner, you can make best use of services provided by NRI Money Clinic. We have team of people who can assist you. How can you reach out to us in case if you have a need? Very simple. Our number is given in the description box below. We have provided a link over there. Click on the link. It takes you to the WhatsApp. Send us an explanatory message and our team of experts are ever ready to help you. Don't delay. Send that message now. Before I conclude, I'll give you a few points. Number one, what consequences will follow if you depend too much on SWP, which gets affected by this sequence of return risk. If you have to depend on SWP for your cash flow, first thing that you have to do is withdraw to the minimalistic extent. I have said in many of the videos, a withdrawal up to 4% of your fund value looks to be something which is manageable. Likewise, this withdrawal should happen from the conservative bucket in your mutual fund portfolio and not from the aggressive bucket. The aggressive bucket should be allowed to grow, should be harvested at periodical points of time, move that money into the conservative bucket, and that is how you have to run the SWP. So don't count your SWP cash flow at 10%, 12%, 14%. It will not work. You will lose capital. Keep your expectation minimal. Don't cross more than 4% and withdraw that money out from your conservative bucket. If you're somebody who is retired already or you are going to retire in next 10-15 years, you should be guided by one video which we have done in the past. What is the best retirement income strategy? My editor will show the thumbnail on the screen here. Go through this video where I have given you a foolproof mechanism by which you can create a sustainable cash flows during your retired life. I have mentioned there are 4 things which are required. One is to manage your liquidity, a fixed deposit, small amounts. You must have an annuity or a guaranteed return insurance plan. Annuity and guaranteed return insurance plans are one and the same. One has insurance on it, other doesn't have insurance on it. Annuity plans are taxable, guaranteed return insurance plans are tax-free up to a certain threshold levels. Third is a rental real estate, which could be residential, ideally commercial, and these days we have got the fractional commercial real estate, which is available for even smaller ticket size, which can create a sustainable cash flow during your retired life. And needless to mention, a lot of money should be held in well-constructed mutual fund portfolio. Dear viewers, hope the video that I have done today helped you to understand the deadly effects of sequence of return risk in a retiring person's portfolio and how to conquer it and what you can do to mitigate the risk of sequence of return risk. If it helped you to understand the finer points around it, please do give me a thumbs up. Do not forget to share these videos with your near and dear ones, friends and relatives, and on all the WhatsApp groups and social media you are connected with. Thank you very much for watching this episode on NRI Money Clinic. I shall be back with you with yet another thought on your life, your money next Friday. Till then, stay safe. Again, I wish you a very, very happy 2025.
Press the bell icon for more details and subscribe our channel.